Two undervalued stocks to consider for September of 2023. This is a series that I try to do every single month of two undervalued stocks to consider for a specific month. A lot of you love these kind of videos. You get a lot of ideas to put on your watch list or potentially, research them and invest in a lot of those ideas. So a lot of you actually really love when I do these videos, and I try to do it once every single month. And it has been getting harder and harder every single month to actually find buying opportunities. It's hard to do whenever the market's going up, especially whenever you have the AI stocks that are shining, but it also presents some opportunities in hated sectors and industries. And this is what I'm going to talk about in this video. I said many times that one of the most hated industries and sectors in 2023 are the retail stocks, REITs, and also healthcare. And this is what I've been pretty much buying in my own portfolio. And I'm going to share two of those undervalued stocks here in this video. And if you're, again, interested in knowing a little bit more about when I buy these stocks, when I sell them, a lot about the micro cap stocks that we've been finding a lot of cheap ones, like some cannabis company in Canada trading at 7 times earnings, growing 100% revenues with 65% insider ownership. A lot of these illiquid kind of names that no one wants to touch them. If you're interested in more of that stuff, you could actually check out my link in the description below, and you could join my own Discord. And one of the most hated sector and industries that I'm going to cover in this video is mainly the retailers, the retail kind of stocks. You've been hearing a lot of bad things around theft and a lot of other stuff. Over $94 billion or $100 billion problem in inventory shrinkage because of theft. You also have higher inflation, which leads to higher wage growth for a lot of the retailers, which means much lower margins. You combine that with a lot of theft, a lot of bad sentiment, and the retailers have been very hated in 2023. And I've personally been buying a lot of them, and I've been looking wrong so far because I'm pretty much either flat or a little bit up or sometimes even down on my positions. But this is not easy to buy some things that people don't want. You have to wait for the sentiment to change. It could be maybe next month, or it could be maybe in 2024, but I'm sure it's going to be way before 2025. And once the sentiment changes and people change their perception around these kind of industries, there's going to be massive price appreciation to the upside, in my opinion. I have been doing this strategy for years, just like what happened with, whenever we had the EV stocks, they were hot and people hated the oil stocks. In 2022, EV stocks crashed 50% and the oil stocks were up 50%. And this has been happening pretty much for as long as I can remember. And this is what I'm going to focus on in this video. And one of the retailers that I want to talk about, which a lot of you actually hate, I'm not sure why. I got a lot of bad comments last time I talked about this company. And this is Ulta Beauty. And Ulta Beauty, again, is down a lot. It was $550 per share. Now it's sitting at $422 per share, the same price it was trading at in early 2022. Most of you are familiar with the company. It says a lot of beauty products, makeup products, skincare products for women, and whoever wants to go there and buy them, they have some kind of a cult following around the brand. Over something like 95% of the brand sales are actually from loyalty members. So there's a very strong cult following from women in the United States around this brand. They can shop on Amazon. They can shop in any place they want. They still choose to go to Ulta Beauty, and this is maybe for certain reasons. They can find a lot of price ranges over there. So maybe if the economy is slowing down, then I cannot afford higher end makeup. Ulta Beauty also has lower end kind of makeup. So if they keep on to buying makeup and other kind of products, Ulta Beauty has all price ranges from pretty much everywhere. And if you look at their recent earnings report, which was actually not bad at all compared to a lot of the other retailers. Most of the retailers in 2023 are putting negative comparable sales or maybe 1 to 2% growth. Now, even with the massive slowdown in 2023 compared to 2022, Ulta Beauty is still putting up 8% comparable sales in the last quarter. Now, this is lower than 14% in 2022, but in 2023 it's still putting up 8%. This is very impressive. If you've been following the retailers, most of them are either 1 to 2% or even negative, and Ulta Beauty is still putting up 8% comparable sales in 2022. This is pretty amazing in my opinion. I'm very impressed about those numbers. You have operating income. Yes, it's the margin is actually down. It used to be 17%. Now it's around 15.5%. This is pretty normal, especially with the higher labor inflation because of the tight labor market. But a lot of those things are eventually going to change in the future. I don't believe their margins are going to keep going down forever. They're going to eventually stabilize it. But this is what the market is pricing in. It's pricing in the worst case scenario in these stocks. And I'm going to show you exactly what I mean here in the video. But if you look at the guidance of Ulta Beauty, again, they expect the comparable sales to start coming down to around 4.5% to 5%. They actually raised the guidance. Their previous guidance was 4 to 5%. Now it's 4.5% to 5.5%. They even raised the EPS guidance. It was 24.70 to 25.40. Now the lowest is 25.10 and the highest is 25.60. So you have an environment where a lot of the retailers are struggling, and Ulta is struggling, but it's actually still growing pretty well in comparable sales. They're even raising guidance on EPS, and this is all pretty amazing, yet the stock went down a lot on earnings for the second time in a row. I don't believe this is warranted. I think this was also some kind of an overreaction with the company, but one of the reasons why Ulta Beauty has been able to raise the EPS target was because they were able to take advantage of the latest dip by buying back a lot of stock. This is what I talked about in my recent video, that Ulta Beauty tends to buy a lot of stock, a lot of buybacks. If you look at their shares outstanding since 2016, they were around 64 million shares outstanding. Now it's around 51 million shares outstanding. So they do buy back a lot of stock, and they took a lot of the cash they had. They bought over $275 million worth of stock over the last previous quarter, which has been pretty amazing. Ulta Beauty knows how to do great buybacks. This is why you could look at the 5-year chart. The stock is way up, because every time the stock goes down, it trades at a low valuation like it's trading right now. Ulta Beauty is going to take advantage of the balance sheet and the free cash flow to buy back stock as much as possible. So if you have good fundamentals and you have the stock going down, you should be happy as a long-term investor, because Ulta Beauty can buy back even more stock at lower prices, which is going to increase your future return as a long-term shareholder of the company. You could look at the balance sheet. It's actually pretty good in my opinion. Current assets are 388 million in terms of cash and cash equivalent. Actually 388 million. They pretty much have no long-term debt except some lease liabilities, which is 1.6 billion, but no crazy long-term debt. So they have a good balance sheet, and they also have around $300 million of free cash flow every single quarter they can use to buy back even more stock, as long as Ulta Beauty stock keeps trading at these very low prices, which is why I love in the company. I want the stock to stay down. I want the company to buy back stock as much as possible, so it could create even more value for me as a long-term investor if I decide to invest in something like Ulta Beauty. And if you look at where Ulta Beauty is even trading at, it's trading around 15.7 times earnings. Now the mean PE ratio, forward PE ratio for Ulta Beauty was around 27 times earnings, and the company is now trading around 15.7, which is a very low multiple on its historical average. It's one of the lowest trading at pretty much since 2009, and we're nowhere close to where we were in 2009. The company has an amazing balance sheet. They're buying back stock at 15 times earnings, whereas the company used to trade at 27 times on historical average. So there's a lot of bad sentiment priced into Ulta Beauty. It's not just Ulta, it's a lot of other retailers. Even some retailers, they put up good numbers and they still go down just because of how bad the sentiment actually is. I really like the company. I like the share repurchases they are doing at those very low multiple. This is the best time to be doing them. And unlike Dollar General has a lot of debt. They can't even buy back stock. Ulta Beauty has a clean balance sheet, and they have over 300 million of free cash flow every single quarter for them to go back and buy back a lot of stock. So I really like the company. I don't have a valuation model on it, but I would expect the company to keep growing revenues 4 to 5% at least every single year. I would expect them to keep buying back like 3 or 4% of the market cap every single year. And I also see a massive multiple expansion once the sentiment changes around the retailers, as it's still sitting at 15 times earnings, and the historical average is 27 times earnings. It doesn't have to go there. If it goes back to 20 times, you're going to have massive price appreciation, especially with all the buybacks that Ulta Beauty has been doing. So I really like this first retailer. The second retailer, most of you are familiar with it because I might be a little bit repetitive, and if you're a technical analyst, this this is actually a pretty good, chart in my opinion on BJ's. It has been stabilizing, and this is BJ's Wholesale Club. I did talk about the company many times before. Most of you are actually familiar with it if you've been watching my videos. BJ's Wholesale Club is kind of like Costco. It has the same business model with the yearly membership, but it's just trade at much lower prices. I'm going to tell you how. It's not a small company. They have over 238 clubs in the United States, in over 19 states, and over 168 gas stations. Pretty much the same exact business model at Costco, but they also have much smaller stores formats than Costco. And a lot of you might be asking me, how can they even compete with Costco? Why would they even do that? Well, BJ's has been competing with Costco for years. They have a lot of members. They have a lot of club stores. They increased revenues a lot. They have over 90% renewal rate. The renewal rate was 81%. It actually jumped to 90%, which has been pretty amazing. But the main difference between Costco, Sam's Club, and BJ's is BJ's pretty much has smaller pack sizes. So if you have a family or two, or maybe single people, or just a couple, two people, they want to go and buy something, BJ's is more convenient for them than buying these huge bulk items like Costco and Sam's Club. BJ's is also more convenient. A lot of people experience a lot of traffic at a lot of Costco's and Sam's Clubs. A lot of people are sick of it, so they are going to BJ's, and BJ's is now starting to experience some of the traffic that Costco and Sam's Club actually are experiencing. The company has expanded in a lot of new states. They have proven that they can actually expand in new states. The demand is there. They are filling in a lot of gaps between the places where there's no Costco or some kind of one Costco store that's very far. I talked about it in my previous analysis, which you should check it out if you want to get a little bit more details, but I really love the company. And if you look at their latest earnings report, it wasn't the best at all, I have to admit. Comparable club sales, they're only up 1.1%. But if you think about 2022, it was a record year for most retailers. Most of the retailers in 2022, they had peak everything. We had peak demand, peak traffic, and a lot of the retailers like Target, BJ's, Ulta Beauty, Dollar General, Dollar Tree, a lot of them are suffering in 2023. The sentiment, in my opinion, could not be worse for these kind of retailers. A lot of people, they don't want to buy them, but the way I think about it is the best time to be buying them is now, whenever there's bad sentiment, whenever no one wants to really touch them. It's not the best time to be buying them whenever the stock is sitting at 52-week highs and everyone is excited about companies like BJ's and Costco. Everyone loved BJ's last year because it provided a lot of stability, because of the earnings are very resilient. People need to eat, people need groceries, but now they don't care about that. They want to take on risk. They want to buy AI, they want to buy Nvidia. So then BJ's actually suffered a lot of, pretty much a massive multiple contraction, along with a lot of the healthcare names, along with a lot of the defense names, a lot of other boring names that offer stability. And this is what I've been pretty much buying in 2023. And if you look at where BJ's is actually trading at, it's trading at 16 times earnings, one of its, again, lowest times on historical average. The historical average was around 17.9, and it also used to trade as high as 22 times earnings. Most analysts and investors, in my opinion, they are not very familiar with BJ's. Most people have never heard of it. If you compare it to something like Costco, which is the same exact business model, Costco is trading at 35 times earnings, while BJ's is trading at 16 times earnings. BJ's is a mini Costco. I always said that. They are growing, revenues pretty quickly, in my opinion. They even have higher gross margins than Costco actually has. And it has a lot of advantages over Costco, but of course, Costco is more popular. It resonates more with a lot of people, a lot of investors. It's a much better, maybe, business model, if you want to say it, because they have much higher same-store sales growth than BJ's. Costco is around 4 to 5%. BJ's is around 1 to 2%. So this could be one of the reasons for the valuation gap, but I think it's unjustified. I think the valuation gap is massive. It has started to close in 2022. BJ's got as high as 23 pretty much times forward earnings, and Costco is trading at 45 times. Well, now BJ's is trading at 16 times, and Costco is trading at 35 times. So I talked about my valuation model in my last video, but the way I think about BJ's, I see see a potential multiple expansion back to 20 to 22 times earnings whenever the sentiment changes around a lot of these retail stocks. And I also see, based on the company's own guidance, EPS growth of high single digits to low double digits, so around maybe 10 to 12% EPS growth. If I get some kind of multiple expansion, I can see around 15% every single year over the next 5 years with BJ's, or something like a double every 5 years. I really like the company. I think there's a massive upside potential with this company. There's a massive future, very long runways. They keep taking the free cash flows, they reinvested into opening more and more stores, over 10 stores every single year. I think the management is also pretty great. It's not going to be affected a lot by the Fed policy. They don't have a lot of debt. They're not very cyclical in the industry. They don't have a lot of discretionary items. Most of their items are necessity kind of stuff, which makes it recession proof, in my personal opinion. So I really like BJ's. I really like Ulta Beauty. I love the retailers in 2023. I think it's the best time to be buying them. I've looked wrong so far. I've been wrong, because I'm not up a lot on a lot of my retail positions, but I still believe the tide will shift, the tide will change. I don't know when. It could be next month, it could be next year, but I'm buying these amazing companies at very low valuations. And, if I change my mind, then I decide to change my mind, and I will update the people in my own investment group, which if you're interested in joining, again, thank you so much for watching the video. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another one.